Gold just woke up. For weeks, it sat quiet, beaten down, forgotten by traders who had given up on it. Then, without warning, it surged nearly 5% off its lows. Behind the scenes, one crowded, one-sided bet had quietly built up. And when the market flipped, that bet came apart fast. Now gold sits just below a major resistance level, the exact point where sellers have struck before. Will this breakout hold, or is history about to repeat itself? Welcome back to Currency Matrix. Whether you're tuning in from across the US or watching from somewhere overseas, we're glad to have you with us today. If this kind of clear, level-headed market breakdown is useful to you, consider subscribing. It helps this channel keep bringing you dependable analysis. Now, let's get into today's gold story. Something unusual happened in the gold market today, and traders are paying close attention. For weeks, gold had been struggling. Prices kept falling, and confidence among traders was low. Many analysts had even started to expect further declines. But today, everything changed. Gold suddenly turned around and jumped nearly 5% from its recent lows. This kind of sharp, sudden move does not happen often, and it caught many people off guard. So what caused this? A well-known market analyst on Currency Matrix explained that part of the answer lies in how traders had been positioned before this move happened. In the days leading up to today, sentiment around gold had become extremely one-sided. Most traders were betting that prices would keep falling. This kind of situation is often risky. When almost everyone expects the same outcome, the market sometimes does the exact opposite. That is exactly what happened here. Around mid-July, data showed that traders had become heavily bearish on gold. In simple words, most people believed prices would drop further. But shortly after that point, the price began climbing instead. This surprised many in the market. When a large group of traders are proven wrong at the same time, they often rush to adjust their positions. This rush can push prices even higher very quickly. Many believe this is part of what fueled today's strong rally. At the same time, gold also managed to hold above a key technical level that traders have been watching for a while. This level had acted as a floor during recent weeks, even during periods of bad news. Despite ongoing tension in the Middle East, including warnings about possible strikes near important oil shipping routes, gold did not fall apart. Instead, it broke out of a downward pattern that had been forming for some time. This kind of breakout often signals that the mood around an asset may be shifting. It's also worth noting that gold miners, which are companies whose stock prices often move in the same direction as gold, also saw strong gains today. This added extra confirmation that the move in gold was not just a small blip, but something more meaningful happening across the wider market. However, the analyst was careful to point out that one strong day does not guarantee a long-term trend. Markets can reverse just as quickly as they moved. The real test now is whether this rally can continue, or whether sellers will step back in and push prices lower again, as they have done several times in recent months. Still, many traders view today's price action as an important shift. After a long stretch of disappointment and stalled momentum, gold finally showed the kind of strength that had been missing. Whether this marks the beginning of a longer recovery or just a short-term bounce remains to be seen. But for now, the mood around gold has clearly changed, and traders everywhere are watching closely to see what happens next. Once gold made its surprise move higher, attention quickly shifted to what comes next. And according to the analysis shared on Currency Matrix, the next few days could be just as important as today's breakout. The first thing traders are watching closely is a specific price level that sits just above where gold is trading right now. This level has acted as a strong ceiling in the past. In simple terms, whenever gold has tried to rise toward this point before, sellers have shown up and pushed prices back down. Because of this history, many traders believe the same thing could happen again. There's also data coming from the options market that helps explain why this level matters so much. In the options world, there is something called a call wall. Without getting too technical, this basically shows the price area where a large number of big trades are clustered. And when gold approaches this area, it can create extra selling pressure simply because of how those trades are structured. Right now, the call wall lines up almost perfectly with the resistance level traders have already been watching. This overlap makes the level even more significant. Beyond the technical side, there is also a seasonal pattern worth mentioning. Historical data going back 10 years shows that gold has often performed well during the months of July, August, and September. This does not mean gold is guaranteed to rise simply because of the calendar. Seasonal patterns are only tendencies, not promises. But when this kind of seasonal strength lines up with a fresh technical breakout, it can add extra confidence for traders who are already leaning bullish. At the same time, broader market data is starting to support the idea that gold's momentum may be shifting. Several key indicators, which analysts use to measure trend strength, flipped in a positive direction for the first time in a while. This kind of shift often suggests that a change in direction is not just happening on the surface, but is being confirmed by deeper market signals as well. Interest rates are also playing an important role in this story. Normally, when bond yields rise, gold tends to struggle, since gold does not pay interest and becomes less attractive compared to interest-bearing assets. However, in this case, gold has been rising even as yields move higher. This is somewhat unusual, and it suggests that other forces, such as safe haven demand due to global tensions, may be outweighing the usual relationship between gold and interest rates. There is also a connection between gold and the US dollar that traders are paying attention to. Typically, when the dollar strengthens, gold tends to weaken, and vice versa. But this relationship does not always hold perfectly. Currently, the dollar has been holding relatively steady, neither strongly rising nor falling. According to the analysis, this steady dollar behavior could allow gold room to continue climbing as long as the dollar does not suddenly break higher. Meanwhile, oil prices have also been climbing sharply in recent days, driven largely by ongoing geopolitical tension. While rising oil can sometimes support gold since both are seen as safe haven assets during uncertain times, there is a limit. If oil prices rise too quickly, it could raise concerns about inflation returning, which may eventually affect how central banks think about interest rates. This makes oil an important factor to watch alongside gold in the coming days. Put simply, gold now sits at a very important crossroads. A key resistance level lies just ahead, reinforced by options market data. Seasonal trends are historically supportive. Technical indicators have turned positive. Yet interest rates and currency movements remain wild cards that could still shift the picture at any moment. This is why many traders are choosing to watch closely rather than rush in. The setup looks promising, but confirmation is still needed before anyone can say with confidence that this rally has real staying power. If gold's rally continues to build, the effects will not stay limited to just one corner of the market. Several other areas could feel the impact, and understanding these connections helps explain why so many traders are watching this moment so closely. One of the clearest places to see this ripple effect is in gold mining companies. These businesses tend to move in a similar direction to gold itself, often even more sharply. When gold rises, mining stocks frequently rise faster, since their profits are closely tied to the price of the metal they dig out of the ground. Today, that pattern held true, with mining-related stocks posting stronger gains than gold itself. For investors who follow this sector, that kind of amplified move can represent both greater opportunity and greater risk. However, there is a complication. Oil prices have also been climbing at the same time, and this matters more than it might seem at first. Mining companies rely heavily on fuel and energy to operate their equipment and transport materials. When oil becomes more expensive, it raises the cost of doing business for these companies. So even if gold prices keep rising, higher oil costs could quietly reduce mining company profits. This creates a delicate balancing act where two connected assets can end up working against each other in unexpected ways. The bond market offers another important piece of this puzzle. Typically, when investors feel nervous about the economy or global events, they might move money into government bonds as a safer place to wait things out. Interestingly, bond markets have shown relatively little reaction so far, even as gold surges. This suggests that not all investors view the current situation the same way. Some are clearly seeking safety through gold, while others in the bond market appear more hesitant or unconvinced that deeper trouble lies ahead. This kind of disagreement between markets is often worth watching, since it can hint at where sentiment might shift next. Meanwhile, the stock market, particularly technology-related stocks, is dealing with its own separate pressures. If oil prices continue rising sharply, it could raise costs across many industries, not just mining. Higher costs can squeeze company profits, which sometimes leads to more cautious investor behavior in the stock market overall. If investors start pulling money away from riskier assets like technology stocks, some of that money could flow into safer options, including gold. This would add yet another layer of support behind gold's recent move. There's also a broader economic angle to consider. Rising oil prices can eventually filter into everyday costs, affecting everything from transportation to manufacturing to the price of goods on store shelves. If this continues for an extended period, it could stir concerns about inflation returning. Central banks pay very close attention to inflation, since it directly influences decisions about interest rates. If inflation worries grow, it could complicate the current interest rate outlook, which in turn affects how attractive gold looks compared to other investments. At the same time, ongoing geopolitical tension remains a major backdrop to this entire story. Ships facing threats near key oil transport routes, along with broader instability in the region, have kept global investors on edge. Historically, during periods of heightened uncertainty, gold tends to benefit as a safe haven asset since it is not tied to any single government or currency. This dynamic appears to be playing a meaningful role in gold's recent strength, separate from the technical and options-based factors discussed earlier. Taken together, these consequences show that gold's rally does not exist in isolation. It is deeply connected to mining company performance, oil price trends, bond market behavior, stock market sentiment, and even long-term inflation expectations. Each of these pieces interacts with the others, sometimes reinforcing gold's strength and other times creating friction that could slow it down. For everyday viewers trying to make sense of it all, the key takeaway is this: gold's next move will not be decided in isolation. It will depend on how these connected forces continue to unfold in the days ahead. As gold's story continues to unfold, many questions remain unanswered, and this is exactly the kind of moment where viewers should start thinking about what they would do in this situation. Would they wait for a pullback before considering any move? Or would they simply watch from the sidelines until the picture becomes clearer? There is no single right answer. Every trader has different goals, different risk tolerance, and different reasons for watching a market like gold. That is part of what makes this moment so interesting to follow. Looking ahead, there are a few key things worth keeping an eye on. The first is that important resistance level mentioned earlier. If gold manages to push through it with strong momentum, that could open the door to further gains. But if sellers step in at that level, as they have in the past, gold could pull back toward lower support levels instead. Either outcome would give traders valuable information about how strong this rally really is. Another factor to watch is oil. If oil prices continue climbing sharply, especially amid an ongoing tension near key shipping routes, it could start to influence how central banks think about inflation and interest rates. Any shift in that outlook could directly affect gold's next move, since gold is highly sensitive to interest rate expectations. Economic data releases will also play a major role in the coming weeks. Reports on inflation, jobs, and overall economic growth can shift market sentiment quickly. If upcoming data continues to show a cooling economy with manageable inflation, that environment has historically been supportive for gold. On the other hand, stronger than expected data could complicate the picture and slow gold's momentum. Viewers should also pay attention to how the US dollar behaves in the days ahead. Right now, the dollar has been relatively steady. But if it suddenly strengthens, that could put pressure on gold prices, since the two often move in opposite directions. Watching this relationship closely can offer helpful clues about where gold might head next. For those who want to stay informed, it helps to follow reliable, fact-based sources rather than reacting to headlines alone. Markets can move quickly based on rumors or incomplete information, so taking time to understand the full picture is always a smarter approach than jumping to conclusions. It is also worth remembering that no single day, no matter how dramatic, tells the whole story. Markets move in stages, and today's strong rally in gold is just one chapter in a much longer ongoing story. Patience and careful observation often serve traders better than rushing into quick decisions based on short-term excitement. So now it's time to hear from you. Do you think gold can push through this key resistance level, or do you expect sellers to step back in, just like they have before? Share your thoughts in the comments below. Conversations like these help build a stronger, more informed community of viewers who learn from each other. Before wrapping up, it's worth reflecting on why this story matters beyond just today's price movement. Gold has long been viewed as a symbol of stability during uncertain times. Its recent surge reflects not just technical patterns, but also real-world tension, shifting sentiment, and the delicate balance between fear and opportunity that defines financial markets. Thank you for spending this time with Currency Matrix. Stories like this remind us that markets are constantly evolving, shaped by data, emotion, and unexpected events all at once. Stay curious, stay informed, and most importantly, stay patient. Until next time, take care and see you in the next episode.